History never repeats word for word, but it always rhymes in the same terrifying way. Every major crisis begins with the same quiet buildup that almost no one notices. People feel richer. Governments promise stability. Banks expand credit like the good times will last forever. But beneath all that excitement sits a math problem that has never had a different ending. Exports rise. Stocks climb. Debt piles up faster than anyone can calculate. Then the illusion cracks, and the cycle resets in the exact same sequence that wiped out entire nations before. The pattern did not start with the Great Depression. It existed long before the 20th century, and it still operates today with ruthless precision. Ancient empires followed it. Medieval kingdoms followed it. Modern governments are still trapped in it. The PDF you provided shows the same 6-stage structure unfolding again and again across 2,000 years. Every stage looks different on the surface. Sometimes you get deflation, sometimes you get inflation, sometimes you get a full-scale financial collapse. But the outcome for ordinary people is always the same. Wealth drains from savers, cash loses power, debt becomes impossible to repay, and only a small group manages to walk out stronger than they walked in. What makes this pattern so dangerous is how familiar it always feels. It begins with confidence. Everyone believes the growth is real. Everyone thinks their savings are safe. Everyone trusts the numbers because the numbers look clean on paper. But the truth sits underneath. Debt grows faster than production. Interest grows faster than income. And the entire system slides toward a point where repayment becomes mathematically impossible. That is the moment where a reset becomes inevitable, not optional, inevitable. The strange part is that across every version of this cycle, 3 types of people survive better than anyone else. 3 positions always come out alive no matter what the crisis looks like. They survive the Depression, they survive the inflation storms, they survive 2008, and they survive the trillion-dollar shockwaves of COVID. But this is only the beginning, because the first time the world saw this pattern unfold at full scale was in the Great Depression. And that is where the first surviving position revealed itself. The first major warning shot arrived in 1929 when the world believed nothing could go wrong. Stock markets climbed nonstop. Banks handed out credit like candy. People borrowed money just to buy more stocks because everyone thought the boom would never end. Then the entire system cracked in a single week and revealed how fragile the foundation truly was. Factories shut down. Wages collapsed. Millions were left without income. Stores could not sell anything because customers had no money. Banks failed so aggressively that families lost every dollar they had saved. It was not just a market crash. It was a full-scale economic breakdown that revealed a simple truth. Cash only keeps you safe when the world is calm. When everything falls apart, cash stops protecting you and starts shrinking in value. The Great Depression exposed the first position that consistently survives every crisis. People who controlled real productivity made it out alive. Not the people with savings, not the people with stocks they bought on margin. The survivors were the ones who owned income-producing assets that kept generating value even when demand collapsed. Farms, factories, essential businesses, anything that produced something the world could not go without. Your PDF shows how periods of collapse always reveal the same thing. Money printed by banks can vanish overnight, but real production never disappears. Those who controlled essential production stayed afloat. Those who relied on paper wealth drowned. The Great Depression proved that the economy does not reward comfort. It rewards resilience. And the strongest form of resilience is ownership of something that keeps working even when everything else stops. But the story did not end there, because the next crisis introduced a different enemy. Not deflation, not unemployment, something far more destructive, something that punished savers even more aggressively than the Depression ever did. The next great collapse did not arrive with empty wallets. It arrived with money that kept losing value every morning. The world shifted from a crisis of deflation to a crisis where cash itself became the enemy. People watched their savings melt in real time and realized something terrifying. A currency does not need to disappear to destroy your wealth. It only needs to rot slowly enough that you do not notice until it is gone. This transition exposed the second pattern that your PDF lays out in brutal detail. Debt grows faster than production. Governments panic. They print money to keep the system alive. That printed money does not create new value. It only stretches the currency like thin rubber until it snaps. The first wave of this disaster appeared in the 1970s when inflation ripped through every major economy. Prices rose. Currencies weakened. Workers demanded higher wages. Governments tried to control the chaos with regulations that failed instantly. People who held cash or savings accounts were wiped out quietly. People who held assets watched their net worth rise while everyone else drowned. But the clearest example came a few decades earlier in Weimar, Germany. A nation buried under impossible debt. A currency collapsing faster than salaries could adjust. Families took wheelbarrows of cash to buy groceries because waiting until the afternoon meant paying double. It was not a temporary shock. It was mathematics. The debt was too large to repay without destroying the currency, and that is exactly what happened. Your PDF shows how this same pattern emerges every time debt reaches the point where interest payments consume all growth. When the math stops working, the currency absorbs the impact. Savings die first. Wages die next. Credit markets freeze, and only people who hold hard assets or fixed-rate debt walk out on the other side. This same inflation trap returned after the global money printing surge of 2020. Governments released trillions. Central banks promised it would be temporary. But the laws of economics do not negotiate. Debt skyrocketed to levels that cannot be repaid in real terms. Inflation surged worldwide and turned every saver into an unintentional donor to the government. Those who survived the inflation storms of the past shared one trait. They held productive hard assets that rose with the falling currency: land, real estate, commodities, businesses built on cash flow rather than speculation. These positions did not just protect wealth. They grew wealth while the currency burned around them. The second crisis revealed the second surviving position. People who owned real assets and people who owed fixed-rate debt gained while everyone else lost. And this pattern would show up again with even more force during the crash that shook the world in 2008. The next crisis did not begin with panic in the streets. It began with confidence. Too much confidence. Banks believed risk had disappeared. Investors believed housing prices could only rise. Families believed debt was harmless because everyone else was borrowing too. It looked stable from the outside, but underneath it was the exact same pattern repeating itself. Housing loans ballooned to impossible levels. Banks packaged these loans and sold them as if they were safe. Rating agencies stamped them with the highest grades. Investors around the world bought them without understanding what they were holding. The entire system became a tower built on promises that could never be kept. Then the first cracks appeared. A few borrowers missed payments, then a few more. Then the entire bottom layer gave out. Housing prices stopped rising. Banks panicked. Credit froze across the world almost overnight. The financial system was supposed to be shock-proof. Instead, it collapsed faster than anyone imagined. Jobs disappeared. Businesses shut down. Retirement accounts fell apart. Families watched their home values crash below the amount they still owed. But through all this destruction, one group survived better than the rest. People who controlled steady, recession-resistant cash flow. This is where the second position from earlier becomes impossible to ignore. People who owned businesses that generated reliable income did not just survive, they became stronger. They bought assets at discounts. They expanded while everyone else was shrinking. Cash flow acted like armor when every other form of wealth was bleeding. The meltdown also exposed something important about debt. Not all debt destroys you, only the debt that moves. People who held fixed-rate loans watched their payments stay the same while the value of the dollar slowly declined. People with variable loans were crushed instantly. One decision determined who fell and who kept standing. The crisis of 2008 revealed the second survivor group with absolute clarity. Those who built income-producing assets, those who held fixed-rate debt instead of floating debt, and those who avoided relying on rising prices to feel wealthy. But none of this compares to the shock that came next, a crisis that hit every country at the same time, a crisis that flooded the world with more new money than any event in modern history, and that crisis reshaped the third and final position that survives every collapse. The next collapse did not begin in the markets. It began with fear. One moment the world was normal. The next moment every business, every airport, and every city went silent. Governments panicked and responded the only way they knew how. They opened the floodgates. Money poured into the economy at a speed no one had ever seen before. Trillions created out of thin air, checks sent to households, loans handed to corporations, bailouts approved in days instead of months. Every country copied the same playbook because no one wanted to be the first to collapse. Your PDF shows the impact with brutal clarity. Global debt exploded past $300 trillion. Total debt hit 335% of global GDP. Interest payments began consuming more growth than the world could produce. The system entered stage 3 of the historic pattern where debt rises faster than the economy can keep up. Inflation erupted almost instantly. Prices jumped, supply chains cracked, currencies lost strength, and ordinary families discovered the hidden cost of emergency money printing. Their savings bought less. Their salaries lagged behind. Their cost of living rose faster than their income. But something else happened that most people missed. The crisis became a massive stress test for every type of wealth. Cash struggled. Stocks became unpredictable. Currencies weakened. Only a few positions remained stable when everything else turned volatile. Income-producing assets kept working. Rental properties kept paying. Essential businesses kept earning. Commodities like energy and agriculture surged because the world cannot shut them down. And people who held fixed-rate debt watched inflation erode the real value of what they owed. Their payments stayed the same while their currency weakened. The COVID era made one thing impossible to ignore. The economy does not reward the people who save the most. It rewards the people who position themselves before the system bends. The world entered a new stage, and your PDF confirms exactly where we landed. We are sitting deep inside stage 3. Interest payments swallowing growth. Debt rising faster than income. Governments trapped by numbers they can no longer control. And history says that once stage 3 hits, the rest of the pattern unfolds like clockwork. But the most important part is this. The same 3 positions that survived every crisis in the last century did not just survive COVID, they thrived under pressure. Every collapse in the last century looked different on the surface. Some destroyed savings with deflation. Some attacked wealth with inflation. Some crushed entire industries overnight. But when you look at who survived each disaster, the pattern becomes impossible to ignore. The first survivor group owned real production, not the illusion of wealth on a screen, not stocks backed by hype. Real assets that created value with or without economic sunshine, farms, factories, rental properties, essential businesses. These assets generated income even when markets froze and currencies cracked. They saved people in the Great Depression, and they saved people in every recession after it. The second survivor group used fixed-rate debt like a weapon. They borrowed money that became cheaper over time. Their payments stayed the same. Their income grew. Inflation worked for them instead of against them. This advantage showed up in the inflation storms of the 1970s and again after COVID, when prices jumped faster than wages. Anyone who locked in low rates before the chaos gained ground while everyone else fell behind. The third survivor group relied on cash flow skills rather than impressive balances. People who built recession-proof cash flow made it through 2008 while entire industries collapsed. They did not need rising markets to survive. They did not need stimulus checks to stay alive. Their income continued because they controlled skills and businesses that stayed valuable no matter what the market did. These 3 positions did not just appear once. They repeated across every major crisis for nearly a century. Income-producing hard assets, fixed-rate debt used strategically, cash flow skills and businesses. Together, they form the only combination that has survived every breakdown since 1929. They protected people during the Depression. They protected people during inflation cycles. They protected people during the 2008 meltdown. They protected people during COVID and the global debt surge. Your PDF shows that the world is already inside the same historical cycle that destroyed entire economies before. Debt levels are unpayable. Interest costs exceed growth. Governments are boxed in by mathematics. And the pattern moves toward its next reset with the same rhythm it always has. When that moment arrives, only 3 positions have a track record of surviving the impact: owning real assets, holding fixed-rate debt, controlling cash flow that does not depend on market optimism. History does not reward those who react after the damage is done. It rewards those who prepare before the pattern completes. Right before every reset, something strange happens. The warning signs become obvious, yet almost no one acts. People see the numbers, they feel the pressure, they know something is off, but they convince themselves the system will hold because it always has. Your PDF shows this moment with chilling clarity. Stage 3 transitions into Stage 4 when interest payments consume all growth. Stage 4 brings the recognition that debts cannot be repaid. Stage 5 turns that recognition into political pressure. And right now, the world is drifting deeper into these stages with every passing month. This is the moment where ordinary people make their biggest mistake. They cling to assets that only work in stable times. They hold cash because it feels safe. They buy bonds because they think governments cannot fail. They trust retirement accounts sitting in vehicles that collapse the moment markets shake. They hold on because they fear changing course more than they fear losing everything. Meanwhile, the cycle keeps tightening. Governments debate relief programs. Central banks fight rising inflation with tools that no longer work. Credit markets turn fragile. Investors chase quick returns because they sense the window closing. Every signal flashes red at the same time, yet the average person stays exactly where they are. The danger in this stage is not the collapse itself. The danger is the delay. People wait for clarity. They wait for announcements. They wait for confirmation. They wait until the reset is already in motion and the opportunity to position themselves is gone. This is why resets transfer wealth on a scale nothing else can match. The people who see it coming move early. They shift into income-producing assets. They secure fixed-rate debt before rates explode. They build skills that generate cash flow regardless of the currency. They position themselves quietly while everyone else argues about whose fault the crisis is. Your PDF outlines how this stage always becomes political. Debtors demand relief. Creditors demand protection. Governments try to please both sides and fail at both. At that point, the reset becomes inevitable. It does not matter whether the method is inflation, jubilee, or conflict. The outcome is the same. Debts vanish. Currencies weaken. Wealth moves from savers to asset holders. And history repeats without mercy. Right now, we are in the window where the pattern is obvious, but the reaction is not. The numbers say one thing, the public believes another, and the people who understand the cycle are already adjusting quietly. The next section closes the story and shows why recognizing this moment determines who rises and who gets erased when the reset arrives. Every crisis in the last century looked unique, but the outcome was always the same. The world pretended the numbers would fix themselves. The debt grew faster, the interest bills mounted, and eventually the system reached a point where math mattered more than promises. Your PDF makes one thing undeniable. We are already deep inside the same pattern that wiped out empires, nations, and entire financial systems before us. Global debt is too large to repay. Interest costs are swallowing growth. Governments are trapped between voters and creditors, and the cycle is moving toward its next reset with the same rhythm it always follows. But history also shows the story does not end the same way for everyone. Some people lose everything because they trust the old rules. Others come out stronger because they understand the pattern before it finishes. The winners are not the richest. They are not the luckiest. They are simply the ones who move first. The 3 positions that survived every crisis since 1929 remain the strongest shield you can build today. Owning income, producing assets, holding fixed-rate debt that becomes cheaper over time. Controlling cash flow skills that stay valuable even when the system cracks. These positions protected people during the Depression. They protected people during inflation. They protected people during 2008. They protected people during COVID. And they will protect people again when the next reset hits. The world is entering the final stages of the cycle. Most people will wait too long. Most people will react when the damage is already done. But you do not have to be one of them. If you understand the pattern, you understand the opportunity. And if you position yourself now, before the reset arrives, you are already ahead of 99% of the world. The cycle is repeating, the window is open, and the choice is yours.